Welcome everybody to the Hopkins Group presentation on smaller companies and how to get access to those within your share portfolios. We're joined by Marcus Burns from Spheria Asset Management, and Marcus will be on in a second. Hopefully you can see him there. So that'll be great. And the reason Spheria was chosen, they're a part of our managed discretionary account portfolio, which again, from a small company's point of view, has been terrific in the last 6 or 12 months. But prior to that, there were some challenges within the small caps and probably haven't performed as well as some of the larger companies. So it'd be interesting to hear what Marcus has to say about all of that. And certainly, again, from a longer term perspective, small caps do add significant value to portfolios, but they are far more volatile than perhaps the larger companies. So it's going to be an interesting perspective on what we're doing, what Marcus is doing with that in regards to Spheria, both in Australia and more recently, they've also got some global small companies as well. The presentation today will focus on the Australian aspect of the smaller companies because it is part of the managed discretionary account, but also just sort of talk about small caps and as to why you should have some exposure to small caps within your portfolios. Just as a housekeeping, obviously, we'll go through the presentation. There will be opportunities to ask questions at the end. If you don't have any questions, I've got a number of questions for Marcus that we can talk about, and then certainly would appreciate any feedback about the webinar and your thoughts on it at the end also. So thank you for that. But I'll get Marcus to sort of do a 15-20 minute sort of presentation on small caps and some of the opportunities that they're looking at, some of the process that they go through to add companies to the portfolio. So hopefully we'll sort of get a bit of insight into how they manage money through that discussion and that explanation as to what they're doing. And then as I say, there'll be some opportunities to ask questions later and hopefully get some little gems that we might be able to add to our own portfolios as well. So thank you, Marcus, for being here today. We really appreciate you being on the webinar.
Mark, it's a pleasure. Thanks for having me. And thank you for giving me the opportunity to speak to your clients directly about how we invest and why we think small caps is exciting. I'm going to frame the conversation a little bit by just giving you a bit of background on smalls. As Mark said, I'll introduce Spheria a little bit and how we invest in small caps. And I'd welcome questions, obviously, if the format is better done at the end, happy to take them at the end. But generally, I kind of like questions going through because I think it makes it a bit more interactive. Just a quick background on Spheria. We are a small micro cap specialist. We invest domestically and internationally. We've been running Spheria now for 8 years. We're part of Pinnacle Group, and prior to that, the team was together for over 3 years. So the team's been together now for about 11 years. And I might just get Devon to tab through to page 8. Actually, well, sorry, the first page there on page 2 just gives you a quick overview of the team. We're now a team of 9, and we manage 4 funds across micro, smalls, and global smalls. Just a quick background on how we think about investing. If you go to page 8, there's a quick quote here that we put in just to I'm not sure, Devon, is that up on the screen there? Presume so.
Are you seeing the back?
I'm just seeing the Hopkins Group in the background. That's all I'm saying. Can you share page 8?
Yep. Let me reshare again. Yep, can you see it?
I've just got the Hopkins Group. I've just got the Hopkins Group in the background. I'm not sure if any of the clients can actually speak and tell me what they're saying, but I'm saying just Hopkins Group on mine. Can anyone on the call actually perhaps tell me if they're seeing a screen, or are they just seeing my face and then Hopkins Group?
Well, hopefully we've got the quote up there. It's certainly on the screen behind us, but
is it? Okay.
But I don't know.
All right. Well, presume people can see it.
We'll work on it in the background anyway. But yeah, perhaps talk to it and then we can work on it.
Okay. Well, anyway, okay. Apologies if you can't see it. The philosophy we entertain is basically very bottom up. So top down means some people will talk about investing on a macro basis. We invest very much Fundamentally, we are, so Matt, myself, and the entire team spend a lot of time looking at companies and doing models. And we're trying to buy companies that we think are trading at a discount to what we think is fair value, obviously. We look for small cap companies that have free cash flows. And what we're trying to do here is screen out those companies that basically don't have real earnings. So in many cases, accounting gimmickry can yield companies that have earnings or reported earnings, but actually the free cash flows or cash flows don't actually match the earnings. We have a process that screens those businesses out from our process. We also tend to avoid companies that are speculative in nature without actually an operating history or cash flows. If you just tab forward maybe a couple of slides to page 11, again, this is just a quick summary of the whole process, Devon, if you don't mind. Yeah, this is like the 30-second elevator pitch we give people. So we look for businesses that have free cash flows through a cycle. And this will all make sense in a few minutes when I actually bring a couple of companies to bear that we've invested in and why we've invested in those, and show you how they got bought by the team. We prefer no gearing or low gearing. So many companies that in small caps can be quite highly geared. That can be very problematic in tough times, especially when interest rates start to rise. The cost of interest obviously goes up a lot and can materially affect the earnings. And then obviously the team does actually believe in good old-fashioned valuations. And so we do a DCF style valuation on all these companies. And then lastly, I would say that in smalls and micros in particular, and this applies also to global companies, the smaller cap the company, the less efficient we think the market is. In many cases, there's 20 to 25, in some cases 30 analysts covering the large companies in Australia and also internationally. So the top 100 companies in the US has got analysts all over them. As you go down the spectrum and into smaller caps and particularly micro caps, the coverage thins out very quickly. And so many companies under $100 billion have 2, 3, maybe 4 analysts covering them. In some cases, none overseas in the States. And that gives us a lot of opportunity to add value by doing bottom-up research. And we think that inefficiency creates the opportunity set for us and your clients and your investments. With that in, I might just tab through to maybe page 12, just to give you a bit of framing. Why do we like cash flows, and why does Spheria base its entire process on cash flows? This chart here just shows you a 20-year return, basically. It's a Bloomberg screen, but if you just filtered out the small cap universe and said, okay, I'm only going to buy companies that have positive operating cash flows. There's no valuations, nothing else, just give me businesses that have positive operating cash flow, and build a portfolio of those companies and see how they traded over time. You ended up with that light blue line. So you materially outperformed the small cap index, which is the dark blue line in the middle. And then conversely, if you said to me, okay, just build, it sounds it sounds logical, but if you build a portfolio purely of businesses that burnt money or lost money, so they had cash flow losses, how would you performed? And lo and behold, you get the red line, which is a material underperformance versus the small cap index. Now, that might sound kind of obvious, but if you go back 2 or 3 years in small cap land, when interest rates got cut to zero, we had a really perverse situation where companies that were growing fast but losing a lot of money actually outperformed the companies that made money. At the time, we called it out as being fairly anomalous, and eventually that did come back down to earth. So our process is designed to screen those money-losing companies out, even although from time to time they do have bouts of outperformance based on speculative interest in the small cap space. I might just tab forward one more page to page 13 there, Devon, if you can as well. And this is also a part of one of the really good things about being invested in small caps is they get taken over. So this chart summarizes all the stocks in our 8-year history that have been taken over in our funds. We've had 35 takeovers. We're not alone in that. A lot of other small cap managers will have had takeovers in their portfolios, and it kind of makes sense. Small companies are more nimble, more liquid, and also takeoverable. So a lot of private equity firms and foreign corporations in particular, they're the 2 main actors in this space. We always argue that if stocks don't get recognized by the marketplace because there's not enough coverage or they're illiquid or there's just not enough information out there for retail investors to pick up the names, eventually private equity or foreign corporates will step in and buy them out. And so on average over the last 7 or 8 years, the takeover premium for these names has been 48%. And because we've got a process very much based on bottom-up valuations and cash flows, many of our stocks get bid out over time if they don't get re-rated by the market generally.
Is there much sort of you expect more takeover activities in the next 12 to 24 months?
Like I think there was a bit of a hiatus last year when interest rates were sort of increasing, and then towards the back end of last year, particularly the last quarter, and so far the beginning of this year, there has been quite a few takeovers. So I think the fact that rates, although they've risen, have kind of stabilized, and there was quite a big discount in valuations between large caps and small caps, meant that there was an attractive opportunity. So there has been a lot of takeover activity, and I think we expect a moderate, a fairly moderate amount of that to continue for this year and into next, based on rates being flattish.
Yeah.
So yes.
Do you actually buy companies because you think they might be taken over, or they get taken over as a function of your process, your value, and making sure the cash flow is positive?
Yeah, Mark, it's a fair question. We don't buy for a takeover per se, but it's more of an outworking based on a decent business, good cash flows, and an attractive valuation. We don't buy them for the takeover solely, but they get picked up if they get ignored by the marketplace. So we have defensive position by buying stocks with cash and a valuation, and if they don't re-rate, then they get bought out typically. So yeah. Maybe Devin, if you just don't mind tabbing through to page 15, just to give a bit of framing here for the background. Yeah, thank you. This Mark touched on the fact that smalls had a fairly tough period over the last 12 to 18 months. This chart just shows you that the dark line there is the performance of the large cap index, so the top 100 names in Australia over the last 2 years. And then the green line and the blue line are the micro cap and small cap index. And you can see a fairly dramatic underperformance from smalls and micros. Smalls is underperformed by about 19 or 24%, and micros by an even greater amount. So what might have caused that? Well, a couple of things. We think less liquidity, so people have gone defensive into sort of large cap liquid names. And then secondly, we'd argue that smalls and micros are a little less diverse than large caps. And so, they're more economically sensitive as rates go up, and consumer spending gets a bit more impacted. Some of the small cap names get sold off more aggressively. So that's created the opportunity, we think, in Australia, and also abroad. Sorry, I jump around here a bit, Devin, but if you tab forward maybe to slide, where is it? Sorry, it's in my pack somewhere. Oh yeah, slide 30 for a second.
30.
Can I just ask a question on that, though? Like, that sort of covers all of the smalls and micro caps. Would the same sort of situation be the case with the positive cash flow ones, or probably a less underperformance?
That's an excellent question, Mark. There's I want to say there's been less of an underperformance from positive cash flow ones, but they've still been pretty sold off. So I think what we've seen is okay, there's a period when rates were rising, then there was a period towards the end of last year when rates looked like they were stabilizing and people thought they'd be declining again. And that brought sort of growth and momentum back into the fore for small caps. And so there's been a big disparity in the last quarter in particular, with people buying up growth names and selling off anything that's been cyclical. So, for example, last year, retail names, as you probably know, property-related stocks, got very heavily sold off because they were seen as more sensitive, and that's created a big divergence in performance. So not every stock that's got cash flow has performed particularly well. In many cases, some have been sold off heavily because although the cash flow producing, the earnings momentum has been negative. So no, there's good opportunity, despite the fact that you'd think logically cash flow stocks would have done better.
Yeah.
Just on page 30 quickly, this is don't want to be too technical here, but an EV to EBIT multiple. So if you like, it's like a P differential between large cap and small cap. And this chart is really obvious on a global basis. So this looks at the MSCI World Index and compares it to the MSCI Small Cap Index. And that multiple of the small caps versus large cap is now 2 standard deviations cheap over its sort of 25-year history here. So, sorry, 15-year history, apologies, in this. So it looks like certainly globally, there's a very good opportunity to get back into smalls versus large. And domestically, this valuation chart doesn't stand out as much because the valuations are a bit, because there's more sort of loss-making companies in the small cap space. It's harder to get a sort of aggregated EV multiple of smalls versus large. But on a performance basis, they've definitely lagged large cap by one of the largest amounts in the history of the small large cap index. So we think there is a good relative opportunity to look at smalls versus large, both domestically and internationally. Okay, I'll tab back, maybe go through a couple of names, if that's okay, Mark, or would you prefer to go through a quick commentary on results? What's
yeah, maybe a quick commentary on results, and I guess also small caps as to why they're important to have in the portfolio for long-term portfolio performance.
Okay, Mark. Well, I always joke about this. Whenever you ask a small cap manager if they should buy small caps, the answer is always yes.
Yeah.
So with that caveat in mind, and that Warren Buffett quote about barbers and haircuts, with that in mind, look, I think smalls is a good adjunct to your portfolio. Oddly, domestically, if you look at the very long-term index performance of smalls versus large, the small cap index does not outperform the large cap. There are periods when it beats it by a large amount and periods when it underperforms. With the outperformance that a decent manager or something we've achieved historically over the index, you've still done pretty well in smalls. So with the decent manager getting good alpha in smalls, and when there's a good opportunity set versus large in terms of valuation, you can make pretty good returns. So we think we're at that kind of point at the moment, subject to interest rates and confidence coming back. But I think the opportunity set's there. What closes it up, I think, is probably rates flattening or declining, which certainly looked like that was the case until obviously the weekend, when we've had a few inflation prints recently that look like inflation's a bit stickier than people were expecting. So, but I still think there's a good opportunity set there. Just touching on reporting, page 17, Devin, if you don't mind. It's been a few months now since stocks reported, but I think the highlights there were that we saw there was a big divergence in returns over the reporting season, not necessarily in relation to earnings. So stocks that beat expectations did particularly well. So I'll talk about retailers here. So stocks like Nick Scali, for example, JB Hi-Fi, Harvey Norman. The retailers that had okay numbers, but in many cases weren't actually great numbers per se, but the expectations were very low. The stocks did particularly well. In some cases where the earnings were pretty strong, but they were well and truly in expectations of investors, the stocks didn't perform so well. So it was a fairly weird set of numbers where expectations were more important than the actual results. As we got there in the second point, with the Australian dollar being weak and with the small caps being fairly oversold compared to large caps, there's been a pretty good turnout of activity back in the small cap space. So we think there's been a very weird period of rotation. We've seen growth names outperform very strongly. Stocks have been more cyclical, the old media names, property stocks being sold off, and some of those areas are creating really good opportunities, we think, to be rotating portfolios into investing. That's summarized again on the next two slides, but it's probably not quite so clear on slide 18 and 19.
Was there any insights from the companies about how the economy was sort of performing? I guess the small caps are potentially more exposed economically. Was there any insight that you can sort of provide on how the future might sort of play out?
Yep, it's a good question. I mean, and frankly, there's so many names, Mark, in that index. I mean, there's 200 in the index, and there's probably another 100, 150 we cover around that. It's hard to sort of gather it up and give you a 1 or 2 line answer on that. But I think the highlights would be that the consumer's been more resilient, generally speaking, than I think people expected. Going back 12, 18 months, there was talk of mortgage cliffs and energy prices, etc., which I think really got people scared about the consumer discretionary sector, so retailers in particular. That didn't prove to be quite as bad as people expected, because there was a lot of savings. A lot of consumers saved a lot of money over COVID, and they've been able to dip into savings. And also unemployment's been pretty low. So even though rates have risen and there's been high utility prices, etc., it hasn't transferred yet into really weak consumer spending. It's been weaker, but it hasn't been a total disaster. That's the first point. And then the second one, I think, has been that inflation, which has been on the front page of the paper every day for the last 2 years, has been coming back. And I talked to Reliance Worldwide Group and Breville as the two names there that really give me some sense of how inflation's going. And both those stocks were pricing up, were pricing inflation through from the costs through to the consumer. And both have said, look, they're not raising prices this year, and in many cases they're seeing price decreases in the cost of goods, particularly out of China. So I think inflation is coming down materially. And yeah, the headline inflation has come down. Obviously, not like the last month has been a bit of an anomaly, but it's been generally trending down from the high levels it was 18 months ago. So yeah, that'd be the two comments I'd make. Consumers are more resilient than we thought. Unemployment has been low, but looks like it's rising a bit. And then inflation, I think, genuinely is coming down, despite the headlines being sticky.
Any insight into sort of wages pressure, and obviously with the tight labour market, and whether that would flow through to inflation?
Yeah, I think, I mean, everyone calls it out, but I still think generally it's less of an issue than it was perhaps 12 months ago. So there's still push for wage increases, but I don't think it's quite as pronounced as it was if you went back, say, 12 months, when obviously, the headline number was sort of 9% inflation. People were getting 3-4, they're pushing for 5-6. Yeah. Headline numbers now sort of 3.5, 4, that kind of level. I think people are pushing for 2-3% wage inflation. So I think my feeling is it's come back. And although, I joke about this, but bond managers who want you to stay in bonds say inflation's sticky. The fact is it has come back down fairly quickly from that sort of 9% level down to around roughly 3% today, which is maybe a touch higher than we'd like, but it's not anything like what it was 18 months ago. So I think
is that true of services companies as well? Or like, are you seeing any of your service sort of retailers, or not retailers, but businesses, is the wages stickier in that area as well? Or
I mean, possibly. I mean, you get other impacts as well. So other than inflation, you get minimum wage and other regulations coming through that tend to have more of an impact than the actual inflation, if that makes sense. So if minimum wage goes up, or is regulated to go up by more than inflation, it's more of an issue than the actual inflation number. And minimum wages has seen upward pressure for the last 2 years, thanks to the Labor government. And so, yeah, I think that's been more of an issue than the actual inflation per se. But the companies are adjusting. So some of the retailers are adjusting shifts and trying to work out clever ways of doing more with less to offset some of those cost pressures. Yeah. So it's all very general. It's very hard to get specific because there's just so many companies, Mark, but hopefully that gives you a bit of flavour.
Yeah, absolutely.
We've generally found it better to invest purely bottom up in small caps than trying to pick top down. Someone wisely once told me years ago that with forecasting, the way to be a good forecaster is to do it often, and in other words, revise your forecast daily so that you always eventually were right. So we just have figured that, of course, Matt, myself, and the team have a view on inflation and the macro variables, probably mostly wrong, but we have a view on it. But we try to look bottom up and see what's priced into stocks, and we found that that's more profitable than looking top down and trying to forecast whether there's a consumer recession or not. I mean, if there's a consumer recession and it's overpriced, in other words, more than the recession's priced into stocks, it's still attractive to buy some of those stocks in those sectors, even although they're going into a tougher time. And if you go back, say, 12 months, the retail sector in particular, and I'll talk about that in a second, but with Harvey Norman, many of the retailers got sold off so heavily because of that skepticism around what was coming down the pipeline with the mortgage cliff and unemployment likely to rise, that the stocks had more than priced in a very, very bad period. And so we actually added to some of those names, and they traded pretty well through this session because even though the numbers weren't fantastic, they weren't as bad as people expected, and so they saw a massive relief rally. Yeah. Maybe we just tab forward to page 21, if that's okay, Devon. Thanks. Okay, so one stock we have added to the portfolio probably a little more than 12 months ago was Harvey Norman. And I guess the two things that stood out for us with Harvey Norman were, well, firstly, we produce a chart, Mark, you would have seen this before, showing, and I don't want to get too technical here, but we look at the accounting earnings. So that light blue line you see in that chart there shows you the accounting EBIT, or EBITA, as we call it, earnings before interest, tax, and amortization. And we compare it to the free cash flow. So we look at the cash flow statement and we looked at to see how that reconciles with reported P&L numbers. Obviously, a good reconciliation, everything else being equal, is a good thing. And Harvey Norman, you can see that over time it converts 93% of its EBITA to free cash flow, which is a really good cash flow conversion. It is cyclical, as you can see, so it goes through cycles as a retailer would. But interestingly enough, if you go back 12 months, you might know that Jerry Harvey's been around out there buying property for about 20 years now, and has a huge property portfolio across Australia and internationally. And it's worth about $4 billion currently. So about a year ago, the stock had a market capitalization of about 5 billion and had about $500 million of debt. So you're paying sort of extra property, you're paying about $1.5 billion for the business, and it was making sort of $300 to $400 million of underlying earnings, excluding the property rental. So you're paying about sort of 4 times, underlying pre-tax earnings for Harvey Norman about a year ago, because it was so out of favor and because people were so worried about the consumer recession. And so we bought a lot of the shares then around the mid threes. It's now rallied to, actually it's gone as high as $5. It's now back down to $4.50. And still very cheap now, still trading at about 6 times underlying earnings if you take property out of a business. So very, backed by property and hard assets, great cash flow generator, pays a really good dividend, has a massive property portfolio to back up the valuation. And Jerry Harvey, I can assure you, is very much alive and well, and as spicy as ever. So that was an interesting idea we bought and have made so far pretty good money out of it. And we think there's still a decent return in the stock left.
With the small caps, is that sort of the upper end of the value that you would go?
In terms of the size,
yeah,
it would be, yes,
yeah.
That's a decently large business. We bought that for both our small cap and our mid cap funds. But it is, so I guess it's a good example of even a pretty well covered, pretty well known business. They can get very oversold from time to time and present good opportunities. And then maybe I'll touch on one sort of
Can I ask one more about Harvey Norman, just the property part of the portfolio? I mean, the market generally is pretty negative towards that, and they keep trying to get him to spin the property part out. Why is it that they don't like the property?
Look, I'm a little more cynical than that. I think that there's probably a lot of bankers who'd like to do the deal. And you could argue that the property sector is maybe a lower returning sector than, say, retail. I mean, you're probably getting a 7-8% return on your property through a cycle, whereas a good retailer, you should be getting double digits. So I guess you could argue that. But on the flip side, you take away a lot of risk from the business, and over time, these properties have done really well. I mean, they're in good corridors around growth areas in Australia. It means they can invest in their stores. So I actually went out to the Auburn store in Sydney about 6 months ago with one of the brokers, and Jerry Harvey took us around, and it was a pristine store. It's one of the best stores they have. He said he owned the site. They own across the road, and they'd really invested in the store because they owned it. Like, there was no 5-year lease after which they'd have to leave. There was a sort of infinite period of time, so they could invest really heavily in the fixtures and fittings, which they've done. It was a great fit out. And I think long term that gives them a really big advantage over many of their peers. So I think it's I think the risk is overplayed, and I think many of the better retailers, Nick Scali as well, own tons of their own property because it gives them more stability. There is an uplift in valuation of property over time. So I think it's overplayed, frankly. And and that's the opportunity. Everyone worries about it. Jerry Harvey's a billionaire for a reason. He's pretty smart at what he does. And we're happy to own it, basically. And maybe you could argue there's a if as I said, if we've done the valuation assuming it looking at the business X property and it's on 6 times EBIT. JB Hi-Fi, to give you some sense of comparability, would be on about 10 or 11 times EBIT if you excluded their property. They don't own any property, so almost double the multiple on a like-for-like basis versus Harvey Norman. And Harvey Norman's pricing is comparable with JB Hi-Fi in pretty much every category except for 1 or 2. It's a very, very much a perception thing, I think, rather than fundamentals. And just quickly, I'll touch on another stock that's in both our micro cap and our small cap fund. And if you go to page 23, please, Devon. This is a sort of growthier name. We've had that has been compounding for many years. It's called Supply Network. The ticker is SNL. It's like Bapcor for truck and bus parts. So it has a number of locations around the country with small white vans that supply truck and bus parts to independent mechanics. It's probably the leader in that space, a very fragmented industry. You can see from the cash flow conversion on the left-hand side, it's a lower cash flow converter than say Harvey Norman, which was in the 90s. But that lack of cash conversion is because it goes into working capital. So reinvest heavily in the core business via new locations and working capital. On the right-hand side of that presentation, you can see that the return on capital is incredibly high, well above 30% for a long history. And then more recently, it's managed to squeeze out even higher returns out of the core business. It's grown its revenue at over 14% a year for about the last decade, which is remarkable for any business, particularly even a small cap in Australia. It's given an EBIT growth rate well over 20%. We've had that in the portfolio actually since we started Spheria, so like 7 or 8 years, and it's given us a return that's been greater than Google's over that period of time, to give you some sense of what you can achieve in a high quality compounding growth machine in small and micros. We own our microcap funds and also our small cap funds, and it's re-rated quite a lot from that period when we bought it, but it's still trading on fairly modest multiples in our view. So we like that company a lot.
With that one, like, is it I know that sort of in Victoria, a lot of the buses are going electric. Like, is it still going to be relevant, in the electric sort of sphere, and how would that impact supply networks?
Yeah, look, good question, and I think it's one of those questions everyone's worried about. There's still a very large number of old buses around and old trucks around, and I think these guys are stocking electric components, and there's still a lot of components in electric buses as well that have to be replaced and maintained. So I don't foresee it as a terminal risk to this business. I think it'll create short-term more opportunity because there's going to be more SKUs as there's a dual park, a dual bus park, electric and ICE engines, the old style bus engines. Eventually in 20 or 30 years time, it may be slightly simpler because you've got EV engines, but there's still tons of parts around that actually add a lot to the requirement to service. So I think the business is going to look pretty strong for quite a few years to come.
When you're sort of looking at things like I suppose that electric bus, when the market sort of says that's a risk to the business, how do you sort of look through that, I guess, from a manager point of view, or how do you come to a conclusion about what might eventuate, or is it sort of comes down to valuation currently? How many sort of years do you look in advance for revenue?
Well, Mark, as you know, all the above is the answer to that. So I mean, if the stock was incredibly cheap, it'd be very easy because you'd say, well, it's possibly more than priced in. So you might price in, if you're worried about the future, you might price in decline and see whether that's overly discounted in the share price. As I said, a bus or a car or a truck, whatever, lasts sort of 10 to 15 years. I mean, the average age of a car in Australia is like 12 years. I think the average age of a truck is not dissimilar, so 10 to 12 years in Australia, and a bus would be at least the same, if not older. So yes, there's a refresh going on. When we've talked to Supply Network and others who work in the industry around supplying and parts, etc. At the moment, they're saying that they're stocking the old style engine components and also many new components for EVs. So there's still cooling fans and pumps, etc., required for EVs. So even though the engine per se is simpler, there's still a whole bunch of other components that we don't see that aren't engine components that go into running a bus, like the brake components, the lighting, mirrors, all the gearing, etc. And so there's literally thousands and thousands of components that go in other than pure engine components. So at the moment, it's actually adding to their SKU base. And in some cases, the pieces are even more expensive than the old ones going out. So you might have a bigger unit worth more dollars than you had previously. And in some cases, that actually creates opportunities. So far, what we've seen is we've asked the questions, we've looked at what the earnings and revenue are doing, and try to triangulate where things could be in a couple of years' time, and it actually looks pretty attractive. So even though it's very simple to say, oh, it's going to go EV, there'll be no bus parts sold. It's just too simplistic, and it's not actually reflective of the real world example so far. Yeah. But no, it's a fair question, and we've had it in our minds for at least 4 or 5 years as well, and asked the question and thought about it and gone through the numbers and probed them quite heavily on these sort of issues. And in the meantime, the stock's probably up 200-300%.
Yeah.
So it's it's done fine, and the numbers are still very strong.
Yeah, absolutely. I will, ask anyone who's on the webinar if they have any questions, just to type the questions in, and we can ask them to Marcus. Was there anything else, I guess, from a presentation point of view that you wanted to go through?
Mike, I was just going to quickly touch on either returns or current holdings. I mean, we should do that.
Current holding of both is really good.
Okay, yeah. Do you want to, Devin, can you just tab forward to page 25 and then 26? So 25 just gives you, this is the Australian small cap fund, and our returns post fees, obviously. So these are all after everything. I guess the highlight here is we've dragged out, returns above the market over the period of time that you guys have hopefully been exposed to us, of roughly 3-4% over above the market benchmark over most of the timeframes, and since inception, which is, as I said, almost 8 years ago now. And equally importantly is our risk metrics. So things like beta, how much the fund wobbles around versus the market, are materially lower than the market. So we have a lower risk profile because of that cash flow and valuation focus than you'd get if you just bought the pure index. And then maybe tab forward to page 26 and you get the current holdings in the fund. And then we have the sector weights on the right-hand side of that. So you can see we're very underweight materials and energy. And we've got exposure to industrials, consumer discretionary, etc. I might just point out that consumer discretionary overweight is not quite as big as it might look in that chart. So on the right-hand side, you can see consumer discretionary is 25% of the portfolio versus the index of about 16-17%. Some names in that are a bit definitional. So Supply Networks, which I just went through, the bus and truck parts supplier, falls into consumer discretionary, even although it's more of an industrial business per se. It's just the way the sectors work out, they end up being fairly unusual in the way they're defined. So it's not quite as aggressive a way, say, retail as people might expect. But see a good mix of businesses there. We try to give consumers, our investors, exposure to a variety of sectors. We're not a one-shot kind of investment house. We like to pick a variety of themes, but it's all based on cash flow and valuation and bottom-up research as to why we own the names and the holdings we have.
One of the ones that's been in the news there is obviously the Star Group. Is that a new sort of addition, and I guess looking at the risk potentially for them to lose their license and things like that? How do you sort of value that as part of the investment case?
Yep, all good questions. And yeah, so it's relatively new. It's not. We didn't own it going back, say, 2 or 3 years. The stock has fallen a long way before we bought into it. We bought into it perhaps a little bit early in hindsight, but it had already come back a long way. And we've helped recapitalize the business. As you know, they've been fined for a variety of malfeasance historically. We try to look forward on these things as well, though, and say, look, it's most of that stuff is rearview mirror. They've replaced the management team. There's pretty much no one there from the management team or the board going back 2 or 3 years now. So there's been a complete refresh of the company. There's a lot of property underpinning the asset as well. So they have very long-term leases in Sydney. They own some property in Brisbane. And as I said, they have the casino license down here and also up in Queensland. So that's very valuable, assuming they don't lose it, obviously. It's under review. I guess our view is if they were required to divest it or lose it, they could either bring in an operator to take the license and operate it in their casino. So they would pay a fee for that operation. Or they'd sell a license to somebody else if they're required to and get some compensation for it. So it's not a total write-off. Obviously, we prefer they kept the license and with conditions around it, and they put in proper practices. So our core view is they retain it and they run the business going forward. If you sort of normalize for what's going on now with high costs, etc., the stock is trading very cheaply. So on around sort of 4 or 5 times EBITDA. Casinos historically have traded around the 10 times multiple, so it's trading probably half the level it would trade at on a sort of through the cycle basis. And so our view is, a lot of the bad news is in the price currently. As I said to you earlier, our job is not just to read the papers and say what's going on today, and that's bad news. We should be selling the shares. Our view is to say, well, okay, we hear the bad news. We do the work on the stock and the valuation and say, well, how much of that is actually in the share price? And if it's overly discounted in the share price, it's an opportunity for our clients. And so Star falls into that camp, even though it's been tough the last 6 months holding it. we think is very cheap at the moment, and we think there's good upside to it. We had a holding in Crown going back a couple of years, and it went through something fairly similar. And it got down to its property backing at one stage. I had my clients, bring up, they're upset about the stock, obviously, and we held on to it, and it got taken over by Blackstone. Sort of 12 months later for almost double the price. So it is worth hanging on through some tough times, assuming they can get through it, which we believe they can. They've raised a lot of money. The balance sheet's now fully repaired. It's just a case of can they get the regulator off their back and start to run the business in a way that's conducive to how they should have run it historically, I guess.
Yeah. And I noticed GWA there again, and you spoke about Reliance Worldwide earlier. I guess again, building, housing demand, housing supply, that type of thing. Is that the theme that you're sort of trading there? Again, obviously based on a bottom up approach, but what's the outlook for sort of housing related stocks?
Yeah, so it was. I mean, as you know, there's been a number of takeovers. I mean, LA Brighton has been taken over. So there's been a lot of takeovers. Boral's been bought out by Seven Group. So there's been a lot of takeover activity in that building material space.
Yeah.
They've managed to pass, all of them, including GWA, passed on price increases. So there's been quite a good pass through of inflation. But GWA is just a good cash flow business. Yes, it is exposed to the building cycle. But it got very oversold. If you go back 12 months, it was very, very oversold. Yeah. Balance sheet was modestly geared. It was on a very low multiple versus its history. And we just thought with that kind of cash flow, that kind of multiple, that kind of valuation, it was very attractive. So we bought it over sort of 12, 18 months ago, and it's performed pretty well for the funds.
Yeah. With the IT sector, obviously you're overweight within your portfolio. Is there many opportunities there? And everyone's obviously talking about AI as well. Is there opportunity for AI within the Australian small caps, or is it have you identified any threats of AI to companies that you may not have invested in? Okay.
So overweight IT, is that what you said, Mark? Sorry.
Yeah. Overweight IT. Yeah.
Yep. Look, AI is. I think it's real. I think it's both a threat and an opportunity. I don't. It seems harder to get direct exposure in Australia than it might be, obviously, to get by Nvidia or Google or Microsoft or Amazon, etc. They've got all the web services that they're hosting. We've got exposure to. I mean, I don't want to be trite about it. I don't want to be funny about this, but things like Harvey Norman. If you believe in AI, there is a big IT refresh. You need to buy better chips to run software, because it is more intensive in terms of calculations. So and obviously things like Data3, which we own in our small cap fund as well, which supplies both the parts and some training and some labor into that, would do fairly well through the AI cycle. So you've got some exposure through that, although that's not really the core reason we own those businesses. We own them for bottom-up valuation reasons, and we've got what we think is a realistic AI scenario factored into both of those names. There will no doubt be some major changes in labor over time. I think it's a bit early to call exactly how that will play out. I mean, there'll be some costs and some wins. I mean, there'll be some sectors that get hit by it badly, and others that'll be created by AI, frankly. So I don't think it's all negative to the economy, and it should be deflationary as well. So and honestly, it's very hard for us to paint a very clear picture on exactly what it means for small caps, and there's not a whole bunch of names that directly win or lose from AI in Australia. But as I said, there's some stocks around the edges that do it. Obviously, NextDC is probably the most obvious play in Australia.
Yeah.
Which, as you probably point out, I'm frankly think it's incredibly overvalued right now. So it's a very capital intensive business. Yes, it's growing very quickly. But I'm not convinced that the returns are in the business that the people expect, and so it's been bid to the moon. It keeps raising money. The return on capital is woeful in NextDC. It's in the 2-3% range currently. It is investing heavily for the future, so you could argue that there's a lot of future capital going into the ground that hasn't had the return coming through yet. But even if you look at the mature data centers in both Sydney and Melbourne, the return on capital looks like it's probably around 10, 11, maybe 12%. which would imply that, you should be trading on sort of 1 to 1.5 times your book value, because it is, you have to buy the land, build the buildings, put the air conditioning units in, the power supply, etc. It's very capital heavy. But the stock trades on 4 times. So it doesn't, to us, stack up as being a good value investment at all, even though there's good tailwinds in that sector.
Yeah.
So yeah, we just caution people saying if you can invest in AI, possibly overseas is better than domestically. And we don't have a lot of direct look-throughs yet in Australia.
Yeah, no, fair enough. And China as well. I guess obviously China seems to be going through the doldrums. I mean, does that sort of impact the smaller companies in the same way, sort of, as it might impact larger ones?
Look, I mean, of course it does, because obviously they're a major exporter. We export a lot of product to China. Immigration drives our sort of, our economy as well to some extent. I guess there's Chinese immigration, which is still ongoing in the background there. That's driving property prices and some of our stocks. But we've got exposure to Terra royalties, as you can see, our 10th largest position there, DRR, which is the royalty over mining area C. So that is an iron ore exposed asset. I guess if iron ore is weak, then that stock is impacted. Obviously we've got mining service names and other exposure to mining, which gets impacted by the Chinese demand. So yeah, we do get impacted to some extent. We're underweight materials, as you can see, because we can't find many gold miners or small mining companies that meet our criteria. The mine lives are short. The cash flow generation is typically pretty poor, and they go through many cycles, which we find less attractive than other parts of the small cap marketplace. So yeah, the small caps are affected by it, either directly through mining or indirectly through mining services, or indirectly again through property prices and other things. But yeah, exposure is not huge directly, but obviously if China's weak, it does drag the economy down in Australia, I think. Yeah.
Obviously, I know the focus sort of today's been on the Aussie small caps, but do you want to talk about sort of global small caps as well? And is the same valuation difference between large and small seen in the global small caps? And what is the case for investing in global small caps?
Yeah. Okay. Thanks. I'll finish on this, and then we can open up for questions. But yeah, I mean, if you just quickly tab through to page maybe 28, Devin, if you don't mind. Thank you. Yeah, this is a long run chart of large cap globally versus small. So the large cap index is the MSCI World, is in the dark line there, and the light blue line is MSCI World Smalls. So small cap, there is a premium in terms of returns for smalls over large over a long period of time. If you test tab forward to the next slide, 29. Yeah, but over the last 2 years, so actually since the beginning of last year, sorry, so the last 18 months or so, that has reversed. So large cap has outperformed small over the last 18 months or so. So somewhat similar to what we've seen domestically. But as I said, the valuation on the next slide is screaming that on a relative opportunity set, you're better off buying smalls than large. So even though large has outperformed, that's created a gap there. So yes, we do think that's a good opportunity. One thing I would say, or maybe 2 things I'll highlight between global smalls and domestic smalls, is that we are finding better value internationally than domestically. So if you tab forward to page 31, there's a couple of names on the right-hand side of this that some of your investors will be familiar with. So many of you will know realestate.com.au, of course. It's been a phenomenal success story in Australia. It's a great business. We own it in our mid-cap fund, but it is pretty expensive. Internationally, we've found a number of global portals that look pretty similar. So in Sweden, there's a business called Hemnet, which is the monopoly real estate portal up in Sweden, and it's probably 5 to 7 years behind Australia in terms of the pricing. So it's got the same model where it gets people to bid up and highlight their property on the website. And so that, but the price to do that in Sweden is probably a third to half where it is Australia. So there's many more years of price increases they can put through there, and that's trading at a lower multiple than realestate.com. Zillow is a leading player in the US. It's not as good a business model as Australia, but it is still the leader, much bigger market, obviously. And there's some good prospects for that business. And if you look down the list there, you might know Altium, for example, which is it's a mid-cap in Australia. It designs software for circuit board design. So when you're building a circuit board for anything from an auto to a washing machine to something, you need some software that can lay the chips out and the design of that. Altium is a cracking Australian business that has a global position in that space, and just got bought out by a Japanese business for a huge premium. We found a stock actually listed in Japan called Zuken, which works in the same field, and trades on about 10 times EBIT multiple. So roughly a third to actually 25% of the valuation of Altium. So globally, when there's not all this money sort of fighting for the few genuine growth names that we have in Australia, you're getting much better businesses at much better multiples. So we just argue that there is a good opportunity to look globally, if clients are interested in that.
How substitute are they? I mean, obviously, Australia's relatively small market, I guess, and sort of smaller number of players, I guess, in realestate.com. It's that and Domain. I mean, are other countries, I mean, how substitutable is it? Or how much can you read in from what's happening in Australia to what might happen, in other areas?
Mark, very fair question. And the answer is, so realestate.com.au has probably the most advanced economics and the most developed business model in the world in real estate portals. You'd normally think it might be the US or somewhere else, but Australia was actually the world leader in that field. And so the way we get the vendors to pay to upgrade their property is world best practice and gives them the best economic return. Hemnet is the only direct comparable right now, the one in Sweden with real estate. And in fact, one of the former CEO of realestate.com is on the board of Hemnet. So there's a direct transfer of knowledge from Australia to Sweden, and many investors have gone across it. So that model is directly comparable. Zillow is not. So you fair to call it out. It's a lead generation model that's not as attractive, and I did make that point. So at the moment, Zillow will never be as valuable on a per capita basis as real estate, but Hemnet could easily be there because it's directly comparable. Hargreaves Lansdowne, which is the next one down there, which is a platform business in the UK. I think it's pretty comparable with Hub and Net Wealth. It's growing at a slower rate than Hub and Net Wealth, to be fair. But it is on probably a third of the multiple, and is a market leader in that market. So, and then Ferguson and Reece are directly comparable as well. So Ferguson is a plumbing distribution business in the States. Reece is the same thing in Australia and the US. Remember, Reece bought a business in the southern states about 4 or 5 years ago. So it's now probably 2/3 Australia, 1/3 internationally, and that trades on double the multiple of Ferguson. So the point we're trying to make is that even if businesses aren't directly comparable, and many of them are fairly comparable, that the multiples are just so far in a way cheaper overseas that for similar growth rates. So we think you're getting a good opportunity to take money out of Australia, where it's a bit crowded. And look internationally to find these sort of world-class businesses that are trading on much more attractive multiples in our opinion.
Yeah. Certainly, as I say, just anyone on the line who wants to ask a question. We haven't had any questions come through as yet, but certainly feel free to do that. I mean, is there any sort of other observations, I guess, about the current state of the market, Australia, globally? Obviously you've talked about the relative valuations of small caps. Is there any other observations that you'd like to, that you've seen?
Look, I think if I was to wrap it up, I'd just say, look, there has been a real bifurcation in the market domestically, and I suspect also to some extent globally, where growth names have been bid up very aggressively. Cyclical names, the property sector, so the REITs, for example, have been really oversold. We are seeing better opportunity in more cyclical names. The property sector we've barely owned property stock in Australia forever. But for the first time ever, we started to buy a few of the REITs down here because they're trading at such large discounts to underlying valuations. So I think, that anomaly is creating good opportunities for us, and we typically do well when we get that. So that sort of that dispersion in valuations creates a great bottom opportunity for us. So we're quite excited by it. It looks like rates, the rate cut story may be pushed out a bit. That's got the market, a little bit scared. But that creates good opportunity medium term, I think. So yeah, we're fairly constructive long term.
Fantastic. We still haven't had any questions come through, so we might wrap it up.
All right.
Wrap it up there. Do we? That's it. change it around. We'll just leave it. So, but Marcus, really appreciate your time today and your insight. I think it's been really valuable for our clients, and hopefully we can. Here we are. Thank you. Where we can, you know, obviously remain invested in with Spheria and partner with you guys and continue that work. So I really appreciate it.
Pleasure, Mark. Thank you. Thanks, and thanks for all the clients for dialing in. Hopefully that was useful background for you guys.
It certainly was. Thank you.
All the best, guys. Thank you.
And don't forget the feedback as well, guys. If you put feedback on there, let us know what you think of the webinar.